Today we ask, are mortgage brokers the fall guys? Hello, I'm Martin North, the Principal of Digital Finance Analytics. And today I want to explore the role of mortgage brokers further in the context of the recent evidence to the Royal Commission, and more importantly, the responses that the banks have put together to try and explain what their view of brokers is. And as we'll see, all is not as it may seem. In response to questions from the Royal Commission, several of the banks have now provided answers on their perspective of what a broker's role is and where their allegiances lie. Do they act on behalf of customers, or are they agents of the bank? And of course, this is all in response to the questions posed by the Royal Commission into misconduct in the banking, superannuation and financial services industry.
So be assisted, I suspect, by submissions from parties generally about what's a deceptively simple set of questions to ask. Who does a mortgage broker act for? You can put it in three ways, I think, and the issue has at least three elements to it. Who does the broker act for? That might be seen as an inquiry about fact or fact and law. Two, who does the customer think the broker is acting for? And third, who does the lender think the broker is acting for? And do you give separate answers at separate steps along the way? If you do, what are the markers that tell you I've gone from a step where this set of answers is appropriate into the next stage where that set of answers is appropriate? So, who does a broker act for? Who does the customer think the broker acts for? Who does the lender think the broker acts for? Are there varying or varied answers at various steps? If there are, what are they? Sort of question that invites you have 3 hours in which to answer it. You may commence writing now, I think. Don't forget to put the number at the head of each page.
And as it turns out, Westpac and Commonwealth Bank have both said that they believe that brokers act for consumers rather than the lenders. So it's insightful to look at the answers that the majors have tabled in response to that question. NAB, for example, has said it depends. It's both a legal and a factual question, which, as posed at the current level of generality, is not capable of a simple answer. The answers to this question will depend on, in any given case, on matters which are not the subject of evidence presented before the Commission, including, amongst other things, the terms of the relevant contract between the broker, the lender, and the broker and the customer and the lender, and the aggregator and the broker, and the aggregator and the lender. The content of extra contractual communications between those parties, and the state of mind of the particular customer and the lender. In comparison, Westpac said that its position was that the broker acts for the customers. Brokers are instructed by and on behalf of the customers, the response reads. Westpac has direct contractual arrangements with aggregators. Those arrangements make it clear that there is no relationship of agency between Westpac and those aggregators. Westpac accredits brokers, but the aggregators that Westpac has a contractual relationship with are responsible for managing broker conduct and requirements. However, Westpac said it was unlikely that customers would think that the broker acts for the lender rather than for the customer or for themselves as an intermediary or as an arranger. And it continued, the broker's independence from the lender is one of the things that customers value about brokers. For example, because they offer access to products from multiple lenders. And to the extent that there is any customer confusion in this regard, such confusion is unlikely to disadvantage any customer. And that is because the customer is likely to consider a broker's recommendation more carefully if they thought that the broker was acting on the lender's behalf. Now turning to CBA. CBA highlighted that customers believe that brokers are their agents and that customers assess satisfaction with their brokers as if they are their agents. It added that broker firm marketing materials also position brokers as customer agents, highlighting statements from both the MFAA and AFG websites to confirm its position. Doubling down on its stance, CBA said the evidence put forward to the Commission during hearings does not establish that CBA regarded an accredited broker as acting as its agent. CBA outlined that its agreements describe head group, i.e. aggregators, as agents, and then only in relation to the completion and collection of customer identification, tax file number disclosure, privacy protection of information, and any bank account opening application. And the bank said accredited mortgage brokers do not act as the agents of CBA. They are authorised by CBA to submit application forms to CBA on behalf of customers who choose to apply for a CBA product. When the broker submits the loan application to the lender, which the customer has chosen, the broker is acting as the agent of the customer, not as an agent of the lender. The bank therefore outlines that its remuneration arrangements with brokers and head groups do not breach its statutory obligation. The obligation imposed upon CBA is an obligation to have adequate arrangements in place to ensure clients are not disadvantaged by any conflict of interest that may arise wholly or partially in relation to credit activities engaged in by CBA or its representatives. As brokers are not agents of CBA with respect to the relevant conflict, they are not representatives of CBA as defined in Section 5 of the NCCP Act. Consequently, the obligations under Section 47(1)(b) do not apply to brokers' activities as there is no relevant conflict that arises in relation to credit activities engaged in by CBA or its representatives, only in respect of separate and distinct credit activities engaged in by brokers. Now that's all well and good. Banks have a vested interest in directing as much business directly through their doors rather than via brokers. So if, in a way, they can reduce the momentum of loan activity through the broker networks, the banks can potentially benefit. But then, of course, remember that many of the major lenders also have relationships with aggregators and brokers. In fact, they own them. So, for example, CBA owns Aussie, Westpac owns Rams, and National Australia Bank, through its Advantage Edge, has relationships with entities like Plan and Fast. So about half of the mortgage brokers in the industry are employed by entities that are directly controlled by the major banks. So I think that what's happening here is that the banks are trying to position a response to distance themselves as far as they can from the activities of brokers and to try and put a position that says, nothing to do with us guys, it's the broker's problem. But I think it's much more complicated than that. First, if you ask customers about their perception of brokers, generally customers believe that brokers are objective, independent, and are acting on behalf of that customer. They also believe that brokers effectively can scan the market and find the best deal for that particular borrower at a point in time. So at that point, the responsibility of the broker is to try and effectively identify the best deal for for the customer, and that's what the customer thinks. And then it switches over into a role of administrator, where effectively the loan application process is managed and shepherded through to completion by the mortgage broker. And effectively at that point, the mortgage broker is capturing information from the customer and wrapping it into a process and then pointing it on through to a bank. Now that bank, of course, is relying on the information from the broker. And therefore the relationship is now quite complex, because essentially there is an obligation on the broker to provide a not unsuitable recommendation, and also on the part of the bank. And as we saw in the Royal Commission, very often the lender actually didn't take account of all the information that was being passed by the broker into the bank. And there's another point too, that of course around half of all loans are actually being written directly by the bank, and so the internal processes within those organisations are also suspect, both in terms of using the HEM measures and other things too. So it's actually quite convenient for the banks to argue that it's all the broker's fault. So to try and answer the Commissioner's question, it seems to me that one, the broker is perceived by the customer to be acting on their behalf, but they may not be. Two, in some circumstances, the broker is actually acting as an agent of the bank, because they are providing information flow to the organisation that is then used to evaluate a loan. And by the way, they're also getting remunerated for that particular contribution. And that takes us to the point of commissions, because of course commissions are paid by lenders, not by customers. And three, we've also got to think of the role of brokers in the context of the aggregators, who are providing a set of tools and methods and systems to enable brokers to do their jobs. But the question really is it the individual broker or is it the aggregator who has the not unsuitable responsibility? Well, at the moment, it seems to me it is actually the broker. So to try and tease out the complexities that we've actually got in the system here, we need to stand back and look at it objectively across the whole of the value chain, rather than seeing it from the point of view of a particular organisation trying to defend its position. And that's what I think is currently going on. So how do I think this is going to play out? Well, I think there are four scenarios that are worth thinking about. Firstly, there is a scenario where brokers' commissions are changed from a variable based on the size of the loan, which of course creates all sorts of conflicts, to a fixed fee. And that fixed fee could well be paid by a lender, or perhaps even more likely, it could be paid for by the prospective customer, a bit like you would when you employ a lawyer or other professional. The second scenario is that there is a move away from the not unsuitable philosophy, which is a pretty low bar, frankly, and basically means that providing you actually are not doing something really silly, effectively the broker is protected. If you were to move it to the best interest settings, which is much more in line with the wealth management industry, best interest is a higher level of duty of care and effectively is fundamentally driven from the needs of that particular consumer. And whilst it may be difficult to police and define, it seems to me that it's quite likely that best interests will come to the fore and be part of the broker solution ahead. The third scenario is to think about what the major lenders will do. It seems to me that it's quite likely that as loan growth is beginning to stall, they will try and put more and more of the new business through their own proprietary channels. So it may well be that at the moment mortgage brokers have reached a peak in terms of their volume share, which will now degrade. And as they do that, it may well be that lenders decide to close the aperture on their mortgage broker portfolios and target a much smaller number of players, perhaps some of the big players, rather than actually the very large number of players that are currently out there. So we could see considerable consolidation in the broker industry driven by banking behaviour. And the final scenario to think about, and it's the one that I think is probably missing in a lot of the submissions that I've read, is that in any case, a lot of what a broker does could be simply duplicated now using technology and technology platforms. And there are examples of new players in the market who are doing pretty much what brokers do, but through automated systems. For example, TikTok Home Loans, who claims to be able to make a loan assessment in around 20 minutes. Now, it seems to me that the digital platforms allow people to be able to search for different loan solutions, also begin to select and prioritize which of those solutions may be most appropriate, and then apply online and in very short order get a response back, certainly to the point of a qualified offer, but perhaps even beyond that, once the other processes and systems are also appropriately engineered to be able to take it to a complete loan application process. So my argument is this, that the discussion about the future of mortgage brokers cannot be had without understanding the major alternative, which is digital delivery of mortgages. And my belief is that in the next 5 years, for example, the majority of loans will be originated online, and therefore the role of the mortgage broker is substantially reduced. In fact, if you think about it carefully, mortgage brokers may not exist in 5 years' time. If you found this useful, please do like the post and add a comment or a question. And if you've subscribed already, thank you very much. I really appreciate your support. And if you've yet to subscribe, please do so to receive future updates. I'm Martin North, the Principal of Digital Finance Analytics. Many thanks for taking the time to watch.